Joining us right now is Cameron Mitchell. He's the founder and CEO of Cameron Mitchell Restaurants. And Cameron, for anybody who hasn't been following along, I think you have 62 restaurants in 14 states plus Washington, D.C. Many of those restaurants are pretty high-end, expensive luxury restaurants. And the word we've been getting from people recently, at least in New York City and maybe L.A. too, is that consumers are spending more at restaurants, willing to spend more on alcohol than they had been in the past. What are you seeing?
Well, I think for us in particular, we're seeing a little bit of movement from our fine dining restaurants down to our more polished casual brands. We're down about 5% year to date in sales in the fine dining level. Now we're that's translated. We're up in our more casual brands. So we're going to finish the year up about 1% in sales, but we're seeing some shift, and people are just spending a little bit less and not going out for that fine dining experience as often as we would have hoped.
Does that break down regionally? I know you have restaurants in places like Ohio, Florida, lots of other states too, but is it different region by region?
There is some fluidity to that, but in fine dining in particular, Monday and Friday lunches are still very soft because people aren't in the office, et cetera. We're also seeing a pullback in, like this December, our large party business is, which is a lot of our bread and butter in the December, holiday months, is down about 15%. So it's challenging out there. We've had a challenging year. Labor costs are still up. Certainly the increased interest expense that's happened throughout the year with the rate hikes. So we've kind of got it from all angles. There are some silver linings, though. I'll tell you, Becky, our guest counts are above 2019 pre-pandemic level. Our cost of goods is now stabilized and dropped and now to pre-pandemic level. Our labor staffing levels are at pre-pandemic levels, which has helped with execution, labor rate stabilization, and lower overtime. And then we finally have gotten rid of all the fuel surcharges we've experienced this year. So there are some silver linings, I think, on the horizon. So I'm still cautiously optimistic going into 2024.
One of the issues is inflation. We've been trying to figure out where things stand, and that has the food aspect to it, but it also has energy and wages. Where do you stand in terms of what you are paying or what your expenses are based on inflation pre and post pandemic?
Well, wages, for instance, we normally increase our prices 2% in the spring and 2% in the fall, about 4% per year, somewhere in that ballpark. And where we took more during the years of the pandemic, this year we passed on our spring price increase, and we only took about 1.5 points this fall. So we feel like we've kind of reached the top end of what our consumer will bear. With that said, labor rates have gone down. They're still up higher than we can raise prices, and still our biggest impact to our P&L. But they are starting to stabilize. And inflation itself and the food issues, our cost of goods, we're seeing not only just in cost of goods, but everything that comes in the back door is starting to reduce a little bit. We're starting to see our prices easing on that side of the fence.
Cameron, one of the reasons I like talking to you is because you cover so many different states, so many different regions, and because we can really get a sense of what small to medium-sized business owners are dealing with. And one of those issues is the availability of capital so that you can do things like open new restaurants. How does that stand, and what are the costs when you do try to build out a new restaurant?
Well, that's been one of the things that's impacted us this year, Becky. We opened 4 restaurants this year, and we're on average, those restaurants were about 6 months delayed in opening, which costs us lost revenue, lost profit, not to mention those restaurants were over budget, so we spent additional dollars to open those. So we've still got supply chain issues on that side with development. We have a full plate of development next year. We have 5 restaurants opening next year, and we hope our situation will be a little bit better, and the cost will come down. We can get them open in a more timely fashion. But on the, when we opened up our Las Vegas restaurant this year, by way of example, it opened up almost 6 months late. However, we had about 5,400 applicants for 180 positions there. So that was really nice for us. We were able to hire just a first-rate staff there, which in years past has been very challenging. So, again, optimistic for our development next year and hopefully a little smoother than this year. As far as credit goes and the banks, we're fortunate. We've got a great relationship with our bank. We've been with them for many, many years. We worked through the pandemic with them and so forth. So we've still got, access to credit. It's just much more expensive. Where I know some of my smaller restaurant friends, I run a group of 7 restaurateurs here in town, and they're finding it pretty challenging to get access to credit on the smaller business side. So I know it's out there, and it's a challenge, I think, for a lot of our fellow independent restaurateurs out in the country.
But that's the difference between somebody who has more than 60 restaurants and somebody who has 5 or 10 restaurants. You've got a track record.
I think so. Yes. Okay. Yes. Absolutely. Especially the single operator, that 1 or 2 restaurant independent operator is really struggling with credit.
But on the optimistic side, on the good news, it still makes sense for you to continue open restaurants, and you are.
Right. And there's lead times on those too. Some of these restaurants we've been planning for over 2 years to open. So and we're still taking advantage of some opportunities that have fallen upon us from the pandemic. So, it's a combination of those two. But we're still, like I said, I'm still positive, and we are able to. I think our P&L will be a little bit better than this year. Challenge. Our profitability was down about 10% this year, and I think it'll come back. Especially what I'm seeing now, especially with cost of goods coming back in line. That was a big problem for us last year. So that's helping, and it's now coming back to normal. So I'm optimistic about 24. Even the election year, I hope will stabilize, and hopefully interest rates will stabilize, if not come down next year.